Is $600 silver an outlandish fantasy, or could it be the inevitable reality of a market stretched to its breaking point? For decades, investors have debated the true value of this unique metal, caught between its ancient monetary role and its modern, indispensable position in industry. But as we stand here in late 2025, after a year that saw silver shatter its nominal all-time highs and briefly touch nearly $55 an ounce, this question is no longer academic. It's a query rooted in a stark and escalating reality. The world is consuming silver far faster than it can be produced, and we are now deep into the fifth consecutive year of a structural market deficit. The core of the issue, the fundamental problem that underpins this entire thesis, is a severe and deepening structural imbalance. According to the latest data from metals consultancies and the Silver Institute, the global silver market is projected to face a significant deficit in 2025, estimated to be anywhere from 95 to 149 million ounces. This isn't a one-time anomaly. It is the continuation of a multi-year trend that has seen cumulative shortfalls since 2021 exceed a staggering 796 million ounces. This relentless drawdown of above-ground inventories from exchange warehouses and private vaults is systematically removing the slack from the system, creating a coiled spring for prices. This isn't simply a matter of miners not keeping up. The supply side of the silver equation is notoriously inelastic. A vast majority of silver is not sourced from primary mines, but is instead a byproduct of operations focused on extracting copper, lead, zinc, and gold. This means that even a dramatic surge in silver's price does not automatically trigger a corresponding surge in its production. Compounding this, the development timeline for new mining projects is a decade-long endeavor, fraught with increasing regulatory hurdles, rising extraction costs, and the persistent challenge of declining ore grades at established mines. While mine output remains constrained, recycling has picked up, hitting a 13-year high in 2025. However, this increase is a drop in the ocean, providing only a partial buffer against declining primary production and failing to close the immense gap created by voracious demand. The market is flashing clear warning signs that the available supply, both from the ground and from recycled sources, is fundamentally insufficient to satisfy the world's growing appetite. We are not just running a deficit, we are structurally incapable of closing it with the current supply infrastructure, creating a profound opportunity for those who recognize the disparity. The first major catalyst disrupting the historic status quo is the undeniable and explosive growth in industrial demand, which now accounts for well over half of all annual silver consumption. Silver is no longer just a precious metal. It has been designated a strategic critical mineral by nations like the United States, essential for national security, economic resilience, and the green energy transition. Its unparalleled electrical and thermal conductivity make it utterly indispensable in the technologies that will define the 21st century. This isn't speculative future demand. It's happening right now at a scale that is reshaping the entire market. At the forefront of this industrial supercycle is the photovoltaic sector. The global push towards solar energy has made it the single largest industrial consumer of silver. Each solar panel utilizes silver paste to conduct the electricity generated, and with the world projected to install hundreds of gigawatts of new capacity annually, this demand is forecast to be relentless. Advanced solar cell designs like TOPCon and HJT, which offer higher efficiency, actually require more silver, not less, potentially driving consumption from the PV industry to nearly 40% of the total global silver supply by 2030. Parallel to the solar revolution is the electrification of the global automotive fleet. An electric vehicle contains significantly more silver than its internal combustion engine counterpart, anywhere from 25 to 50 grams per vehicle, used in battery management systems, electrical contacts, and charging infrastructure. As EV adoption rates accelerate globally, this creates a vast and entirely new channel of inelastic demand. The green transition isn't just a policy goal. It's an engine for unprecedented silver consumption that is baked into the foreseeable future. Beyond the green technologies, silver's role in all forms of advanced electronics continues to expand. From the smartphone in your pocket to the complex circuitry in 5G infrastructure and the demands of AI data centers, silver's unique properties make it irreplaceable. This broad base of industrial consumption provides a powerful and rising floor for demand. Unlike investment demand, which can be fickle, industrial demand is sticky. Manufacturers need to acquire silver to produce their goods, often regardless of price, creating a powerful and inelastic bidding force in the market. The second, and perhaps more powerful, catalyst is a global awakening to the risks inherent in our financial system. In an era of persistent geopolitical turmoil, rising government debt, and the steady erosion of fiat currency purchasing power, investors are increasingly seeking refuge in tangible, safe haven assets. This is not just a Western phenomenon. In fact, the most profound shift is occurring in the East, where a deep-seated cultural affinity for precious metals is converging with powerful economic forces, fundamentally altering the dynamics of physical investment demand. India has emerged as a titan in the physical silver market, frequently challenging the United States as the world's largest consumer. Indian investment demand is undergoing a stunning transformation. While traditionally associated with jewelry and silverware for festivals and weddings, an astonishing 70% of retail demand in 2024 was for investment-grade silver bars. This signifies a monumental shift in perception, from viewing silver as a cultural good to embracing it as a primary vehicle for wealth preservation against rupee devaluation and economic uncertainty. The investment story in India is deepening and becoming more sophisticated. Silver exchange-traded products, or ETPs, which only launched in the country a few years ago, have seen explosive growth. Holdings have surged, indicating that a new class of Indian investors already active in the equities market is now gaining exposure to silver. Inflows into these funds have been multiples of their historical averages, demonstrating a broad-based and accelerating conviction in silver's future. This rush into both physical bars and paper products shows a powerful multi-layered demand structure. China, the world's other demographic and economic superpower, is exhibiting similar trends. A surge in demand for investment-grade silver is being driven by a desire to protect wealth from a volatile domestic property market and a fluctuating currency. Across both China and India, this isn't just retail interest. It's a strategic accumulation of a monetary asset by a populace that understands its intrinsic value. This Eastern physical demand acts as a powerful sink, absorbing metal from the global market and locking it away in private hands, permanently tightening the available supply for the rest of the world. A third critical catalyst is the shifting policy landscape, particularly from the world's most influential central bank, the U.S. Federal Reserve. After a period of aggressive tightening, the consensus points towards a cycle of monetary easing. Potential rate cuts in 2025 and beyond make holding non-yielding assets like silver and gold more attractive by lowering the opportunity cost. A weaker U.S. dollar, which typically accompanies a Fed easing cycle, is another significant tailwind, as it makes dollar-denominated silver cheaper for foreign buyers, further stimulating global demand. Furthermore, governments themselves are beginning to view silver through a new strategic lens. The recent U.S. designation of silver as a critical mineral is a landmark policy shift. This move acknowledges the nation's heavy reliance on imports for a metal vital to defense, technology, and energy independence. This designation paves the way for potential government stockpiling, domestic production incentives, and even trade protectionist measures like tariffs, all of which would act to constrain global supply and potentially bifurcate the global market, creating regional price premiums. The tipping point for the silver market may not be a single dramatic event, but rather the dawning realization that the structural deficit is irreversible under current conditions. We are witnessing a collision of unstoppable forces: inelastic industrial demand driven by the legally mandated green energy transition, and burgeoning, price-insensitive investment demand from the East. At some point, these two colossal demand centers will be forced to compete for a dwindling supply of available physical metal, a competition that the paper-dominated Western futures markets will be unable to contain. The mechanism for this tipping point could be a delivery crisis on a major exchange like the COMEX. For years, the silver price has been discovered through the trading of futures contracts, where the volume of paper claims often exceeds the underlying physical inventory by orders of magnitude. A silver squeeze event, far larger than any retail-driven movement, could be triggered by a consortium of industrial users or sovereign entities demanding physical delivery of their contracts, exposing the fractional reserve nature of the market and causing a catastrophic failure of the pricing mechanism. This scenario is no longer theoretical. We've already witnessed significant stress and delivery issues between the London and New York markets, creating dislocations and highlighting the fragility of the supply chain. As accessible inventories in exchange warehouses are depleted to satisfy the ongoing deficit, the buffer that has prevented such a crisis is being worn dangerously thin. The tipping point arrives when the market finally questions the emperor's clothes and discovers there is not enough physical metal to make good on all the paper promises. Another potential trigger is the gold-to-silver ratio, a classic barometer of relative value. Historically, this ratio has averaged between 50 and 60 to 1. As of late 2025, it continues to hover in the 80s, suggesting that silver remains profoundly undervalued relative to gold. A reversion to the historical mean, which has occurred repeatedly throughout history, would imply a silver price that dramatically outperforms gold. Such a reversion often happens rapidly and violently, acting as a catalyst that awakens the broader investment world to the deep value proposition in silver. The immediate impact of the market recognizing this irreversible shortage will be a dramatic and chaotic repricing event. The surge to nearly $55 an ounce in October 2025 was merely a tremor. The main earthquake will occur when the price breaks free from its historical constraints and begins to reflect the reality of its industrial necessity and monetary scarcity. A move to $100 would simply be the first major psychological barrier to fall in this new paradigm. The aftermath would see silver reclaim its status not just as a precious metal, but as a critical strategic asset. This repricing would have profound consequences across the global economy. The input costs for key industries, from solar panel manufacturing to electric vehicles, would rise significantly. Companies that have not secured their own physical supply chains would face existential threats, while those holding physical silver inventories would see their balance sheets transformed. It would trigger a global scramble among corporations and governments alike to secure the remaining available ounces, adding jet fuel to the fire. In the aftermath of such a repricing, we would witness a massive transfer of wealth. Those who held their savings in physical silver would be rewarded for their foresight, seeing their purchasing power dramatically increase. Conversely, those holding assets denominated in currencies that are being devalued would experience a significant loss. This isn't about getting rich, it's about preserving wealth during a fundamental reset of asset values, a phenomenon that has occurred countless times throughout monetary history. The new financial landscape would see silver's monetary characteristics come back to the forefront. As faith in unbacked fiat currencies wanes, the world will naturally gravitate towards assets with intrinsic value. The narrative that silver is merely poor man's gold would evaporate, replaced by an understanding of its unique dual nature. An indispensable industrial commodity with a 5,000-year history as a trusted store of value. This dual demand profile gives it a potential upside that even gold cannot match. Looking forward, the trajectory appears set. Forecasts based on these powerful fundamentals see silver establishing a new, higher equilibrium. Projections for 2026-2027 range from $60 to over $100 an ounce, driven by the persistence of the supply deficit and the continued growth in both industrial and investment demand. Reaching a price of $200 is not a matter of if, but when. It is the logical outcome of a market where consumption has structurally overwhelmed production for the better part of a decade. The prospect of $600 silver, while seemingly astronomical today, becomes plausible when viewed through the lens of a monetary crisis. In a scenario where a major currency loses public confidence, historical precedent shows that citizens flock to precious metals. The resulting rush into a physically constrained market could lead to a price spike of an order of magnitude that is difficult to comprehend from today's vantage point. It would represent a complete remonetization of silver in the public consciousness. The supply chain itself will become a focus of national security. The concentration of mining and refining in a handful of countries, such as Mexico, Peru, and China, represents a significant vulnerability. Geopolitical tensions, resource nationalism, or trade disputes could easily weaponize this supply chain, leading to export restrictions that would further starve an already desperate market. Nations will be forced to build strategic stockpiles, adding yet another layer of demand. Innovation will also play a crucial role. While there are efforts to reduce the amount of silver in certain applications, known as thrifting, these are often offset by the sheer scale of deployment and the fact that higher efficiency technologies often demand more silver. On the other hand, new battery technologies and medical applications could open up entirely new demand vectors, further tightening the market in ways we cannot yet fully predict. Silver is at the heart of the next wave of technological innovation. The long-term significance of this moment cannot be overstated. We are moving from a world of perceived abundance to a world of acknowledged scarcity. For decades, the immense paper leverage in the futures market has created a perception of ample silver supply, keeping prices artificially suppressed. That illusion is now colliding with the hard reality of a physical deficit that can no longer be ignored. The paper tail has wagged the physical dog for a long time, but that relationship is about to violently reverse. The ultimate takeaway for any investor, institution, or government is the need to distinguish between price and value. The nominal price of silver has been volatile, subject to speculative flows and paper market machinations. Its intrinsic value, however, is rooted in its irreplaceability in industry and its historical role as enduring money. The current market dynamics suggest that the price is on an inevitable journey to catch up with its true and rapidly appreciating value. This is a story of converging megatrends: the global energy transition, the re-emergence of the East as the center of economic gravity, the escalating geopolitical risks, and the universal search for a reliable store of value in an unstable financial world. Silver stands at the nexus of all these trends. It is not just a participant in this new era, it is a critical and indispensable component of it. Therefore, the strategic imperative is clear. The opportunity lies in recognizing the deep structural imbalance before the broader market is forced to confront it. The current pause in silver's ascent after its recent record-breaking run is not a sign of weakness, but a window of opportunity. The fundamental drivers, the relentless deficit, the insatiable industrial consumption, and the powerful wave of global investment demand, are not only intact but are accelerating. The question is no longer if silver's day is coming, but how dramatic the repricing will be when it finally arrives.